Hello, David Ansara here of the Center for Risk Analysis, where we help you to understand risk in the current environment, to prepare for an uncertain future, and to prosper tomorrow. Today, we're talking about inflation, and inflation poses a risk to the wealth and the savings and investments of ordinary people. And to help us understand inflation a bit more, we're joined by Rob Price, who's the head of Asset Allocation at Alexander Forbes. He's currently based in the United States, in Los Angeles, and he's joining us today. Rob, welcome to the CRA channel.
Thanks. It's good to be here, David.
Great, Rob. So you wrote an article recently, which we'll link to in the description, where you tried to emphasize that CPI is not necessarily always the best measure of inflation or the best focus for the discussion around inflation. Could you tell us why you think that is, and also give us a more broader understanding of what inflation means and why it is a risk?
Sure. Thanks for the opportunity, David. For me, I think the key point is that CPI is just an oversimplification of inflation. CPI is one version of inflation. True inflation is actually the amount of new money that is created in a currency. I'll try and keep this simple. It's a really important concept, and I think we need to apply our minds to really get a grasp on this. So, new money is created in numerous different ways, but I'll give a few simple examples. The central bank could print new money, the government could issue new debt, or banks could create property loans or business loans. But this is a creation of new money. It's not necessarily capital or wealth. That's just generation of new money, a new quantum of rands. And of course, the same thing happens in other currencies too. That is an inflation of money. You're getting more money. And when you have more money in the system, there are consequences to that decision. And one consequence could be higher CPI inflation, but that is just one consequence. There are other places where monetary inflation can find expression. And even within CPI, there's obviously a lot of detail below the surface, because CPI is a representation across the economy, the consumer price basket. So below the surface, you could be having very high inflation on some goods and low inflation on other goods, but potentially even deflation, lowering falling prices. So just single-mindedly focusing on CPI alone is an oversimplification.
So Rob, just in terms of some of the second order effects of the low interest rates that we're seeing essentially since the global financial crisis in 2008, 2009, what do you think are the potential long-run consequences? Because it doesn't seem as if there's been an immediate inflationary effect on CPI, but your suggestion to focus the lens a bit wider, what are some of the second order effects, the secondary consequences of this massive amount of quantitative easing and monetary stimulus that we've seen over the past decade?
Sure. So, one consequence could be higher CPI inflation, and we can get on to that. But for me, the bigger conclusion is this, once again, that there are implications no matter what happens with CPI inflation. What we saw post the global financial crisis was large amounts of monetary inflation, and this new money found expression in asset prices, the price of property, the price of equity, and that is a very important consequence. It's not just that's not just a throwaway outcome. When you're seeing those assets go up in price, that has consequences. It has consequences on things like wealth inequality. We shouldn't be surprised when we see rising wealth inequality, when we've got policies that specifically try to raise the price of certain assets. And this is very important for us to be aware of, because we sometimes focus on the outcome of things like wealth inequality and how to try and redress them. And I'm not saying that we shouldn't focus on those things, but if we don't try and think about some of the underlying causes, some of the policies that we're specifically implementing, which create those outcomes, well, we're chasing our tail a little bit.
Rob, so what does this mean to ordinary people who are concerned about the future of their investments and their own assets? And how does that affect their ability to plan for the future?
So, David, we're seeing a lot of people talk about this inflation versus deflation debate, and it's an interesting debate, and we need to obviously have a perspective on the future. But the point that I'm making to you here is that there is large amounts of monetary inflation taking place, no matter what happens with CPI, and there are consequences to this. The value of our cash is being eroded relative to some other assets. Now, we can't always be sure exactly which assets are going to inflate in price, but that will take place. So from an investment perspective, that's a very important theme for us to be aware of. When we think about our asset allocation, we have to be aware that cash, globally, this is not just a South African phenomenon, is going to struggle to hold its value over long periods of time when we're creating lots of new money and we're lowering the interest rates that we can earn on that cash. It's forcing us to buy other investments, despite the fact that some of these investments can still be quite risky. I mean, we have an encouraging outlook on the return performance on things like South African government bonds, despite the deterioration in the South African creditworthiness. So this is a very important contrast to be aware of. And for individuals, this is a tough time because it's a very difficult decision to make. The uncertainty usually leads one to say, let me keep my money in cash. And historically, that's not been a bad decision. You keep your money in cash, you earn a decent yield, and you wait for the uncertainty to dissipate. But under current conditions, we have to think about things a little bit differently. And I'm not going to, give people exactly the answer. Of course, individuals need to speak to their, financial advisors, and they need to get the advice that's right for them. But what I'm telling you is that we have to think about it a little bit differently, and we will be forced into taking some other risks. And we need to think to ourselves, okay, well, what is the risk-return trade-off in these different asset classes? And how do we protect the value of our wealth? Because just because CPI is contained doesn't mean that the value of your cash is not being eroded.
So, Rob, I think that's very good advice. But going from the micro level back to the macro level, in terms of the decisions that policymakers should be making going into the future, how do we make recommendations to government, to central banks, on how to avoid some of the risks associated with inflation?
Sure, great question, David. And that's the most difficult one of all. I think for me, the key is understanding these concepts. So we've really got to get our head around these concepts and not oversimplify. We have to understand that there are consequences to the policies that we are implementing, even if we don't see it in CPI. This myopic focus that the only consequence of monetary policy is CPI inflation is a complete oversimplification. And it's dangerous because, as I've suggested to you, and I've only spoken about one of these consequences in wealth inequality, but believe me, there are numerous other consequences below the surface that are impacting the way our economies work, how we form capital, how we build our communities and societies and businesses. There are all sorts of negative consequences to these repeated policies to lower interest rates, create money, take on new amounts of debt. And so we need to build our understanding of these concepts. We need to take steps in order to protect our wealth. And then we need to try and lobby for slightly different outcomes. Now that's a challenging thing to do. I won't, I'm not gonna deny that. But the first step is understanding them, taking steps to protect our wealth, and then speaking about these things and trying to lobby for different outcomes. And hopefully, in the future, we won't be, living in a world where we just turn to lower interest rates and debt as the solution to all problems. Because, as we've seen over the last kind of, 10, 20, you could even take it further back, 30 years, this type of I call it a short-term focus, really trying to, who cares about the future? Let's just take on debt, lower interest rates, and try and solve the problems today. And that's very short-sighted. It's not very strategic. Once again, not a South African problem alone. It's a global phenomenon. And so we really got to grapple with these concepts and push back against these overly simplistic narratives.
Well, thank you, Rob. And I think that's the ethos that drives this channel, is trying to understand the risks and preparing accordingly so that we can mitigate those risks and preserve wealth and prosperity into the future. And I think what's striking about your comments there is that, I think that there is generally an aversion towards certain kinds of risks, and trying to eliminate all risks can actually create greater, more impactful risks down the road. So I wanted to thank you very much for sharing your perspective with us today, Rob, and would certainly love to have you back on the channel.
Pleasure, David. Good to be with you and your viewers.
Great. Well, that's it from me, David Ansara. Please do join us again tomorrow for more insight and perspective. And remember to follow the link in the description below for our 30-day free trial. Do like this video and remember to subscribe and hit that bell icon as well. Also, let us know what you think in the comments. Do you think inflation is a risk at this present point? And we'll be happy to engage with you there. Until tomorrow, take care.